Hello and welcome. You're watching the Global Reset from the CNBC-TV18 Prime Ionic Wealth Studio. I'm Prashant Nair. Today we are zooming into one of the fastest expanding and least transparent corners of global finance, private credit. This is the industry which has grown 10 times in assets under management over the last 10 years, reaching $3 trillion in AUM at the start of 2025. For the United States, what began as a niche alternative to syndicated loans has grown into a multi-trillion-dollar ecosystem, one that is now deeply entangled with banks, insurers, and corporate balance sheets as well. Many finance billionaires have recently sounded alarm bells around the private credit space in the US especially. This happened at the New Economy Forum in Singapore a couple of weeks ago. Let me list out a few of these specific quotes from some of these finance gurus who were at that conference. First up, Mark Coombs of Ashmore Group, he's the CEO of the Ashmore Group, had this to say, and I quote, "When I see cockroaches, I scream and run away," and that probably sums up my view to developed market private credit. When investors don't mark to market and assume there's enough dry powder, many times it's all good until it isn't. Mark Rowan of Apollo Global Management, he's the CEO, had this to say, and I quote, "It could be time for investors to take risk down by moving up in credit quality. Asset prices aren't cheap and long-term interest rates are likely to stay high." David Vellers, co-founder of New Holdings, had this to say, and again, I'm quoting here, "There is some frothiness in the private sector. I'm sure there will be bad investments in this area and we will see where that lies. Loose regulations around disclosures are adding to the risks." End of quote. Now, Moody's Ratings' latest cross-sector report argues that innovation is no longer the side story in private credit. It is becoming the risk. New structures, hybrid partnerships, cross-border tranching, off-balance sheet entities, and increasingly flexible payment features are reshaping who ultimately bears the risk when or whenever credit cycle turns. Before I bring in the author of this report, and of course we'll have some time to talk to him about what he's making in this space, let's actually set the stage with just 5 quick graphic plates for our viewers which capture the essence of what Moody's is really warning about. Now, private credit isn't just growing, it's getting structurally more complex, Moody's says. And that complexity is now a key source of hidden risk, especially where leverage sits off the balance sheet. We're also seeing deep new linkages between private credit funds, insurers, and banks. These partnerships boost capacity, but they also tighten channels through which stress can spread. Corporate carve-outs and joint ventures are helping companies raise capital more creatively, but they can also push leverage into darker corners away from where investors normally look. Flexibility is becoming the new selling point. Hybrid funds, withdrawal gates, and PIK toggles, and we'll ask the author of the report what that means. Yet each layer of flexibility, Moody says, introduces its own liquidity and refinancing risks when markets tighten. Finally, Moody's Ratings warns about covenant erosion. Once unthinkable in private credit is now common. It keeps deals flowing, but it also weakens lender protection when performance starts to slip. Well, so that's the backdrop. That's essentially what Moody's is saying out there. It's a market, as I said, which has exploded very, very quickly. 10x growth in AUM, $3 trillion at the beginning of 2025, perhaps larger now, and it's perhaps outpacing some of the guardrails that traditionally help investors assess risk. With that preamble, let me bring in the author of the report. Colin Ellis is Managing Director, Center for Credit Research at Moody's Ratings. Colin, great to have you with us here. And, before we get into some of the nitty-gritties of all of this, let me ask you a simple question. For the uninitiated, what exactly is private credit?
Well, Prashant, it's first, thank you for having me. It's great to be here. And I think that's an important question to start with, because to many people, private credit is still a little bit unclear. At its simplest, probably the simplest way I can describe it is private credit is when somebody that is not a bank lends money to someone else. Because most of the time when we think about loans, when we think about borrowing money, we're often thinking about the banking system being in the middle and playing a role between savers and borrowers. But actually, with private credit, you get investors and asset managers and even family offices sometimes making direct loans to companies and other institutions that want to use that money in the way that they would normally use a bank loan. So that's its simplest. It's kind of direct lending, not from banks. But actually, our definition of private credit is much broader, and it covers a whole range of things, including infrastructure, securitization, and lots of other aspects of that market, which are basically tied to that central model of lending somebody money when you're not a bank.
No, that's very helpful, Colin. But broadly, this is direct lending, not bank lending. Does most of it go to private companies, hence private credit? Or not necessarily?
Well, so for me, I think the label private credit comes from the fact that a lot of the early players in this space, a lot of the asset managers that started doing this, were originally private equity firms. So, with a private equity model, obviously, that's where you get an asset manager that takes a company private or owns it privately, often with some leverage, and they try and improve the business and sell it for a profit. And a lot of those names, Apollo is a big player in the private credit space. They were originally a private equity firm. So I think the private comes from the fact that this is something that is not typically managed in as transparent a manner as we would expect in public markets. And indeed, it's part of some of the challenges with private credit. The old joke, of course, about private credit and private equity is, what part of private don't you understand?
Colin, so people who are borrowing through this route, right, directly. So why go through the route from a borrower's perspective? Beg your pardon. Are they not credit worthy to get money from banks or former large financial institutions?
So I think when private credit started, there was certainly an element where, particularly in the US, which is a relatively deregulated financial market, certainly compared to other parts of the world, and disintermediated finance or market-based finance was much stronger. After the global financial crisis, there were plenty of banks that played a role in helping to raise money or syndicating finance for companies that kind of stepped back from that a bit, because that was one of the riskier activities that they did. And obviously, post the global financial crisis, there was a big regulatory focus on banks taking on less risk, and becoming safer. And that did create a space for some borrowers that are probably a bit riskier. I think from our perspective, we think most companies that borrow in private credit are probably what we would say are a single B rating at best, or more likely a CAA rating, so down at the bottom of our rating scale. And that's a risky proposition, right? There are, if that characterization is right, CAA is where we would expect to see a lot of defaults in our data. So if you're managing a portfolio of loans to these risky companies, you have to manage it carefully. And the fact that banks step back from helping some of that lending happen did create space for some of these private credit lenders to really emerge and start growing. But I think the industry has also evolved since then. And I think one of the pieces of feedback we get now is that actually private credit can be a lot more flexible sometimes than the more traditional forms of finance. And even though it might be a little bit more expensive sometimes, that flexibility is actually often very attractive for borrowers.
No, absolutely. Now let's talk about the linkages here, right? Because so these entities take on risk, and maybe they're not the highest rated borrowers who they are lending to, and so it's their problem. But obviously, it's not just their problem, right? It is. It's, as you heard some of those quotes from those finance gurus in Singapore. It seems to be a bigger problem. Why is it a bigger problem? When you talk about anything to do with credit or the economy, banks, especially in the last 15 years, banks are the center of it. You said banks have pulled back, and arguably bank balance sheets are actually pretty healthy, especially in the US. So where are the linkages, and why is this? Why could this? We'll talk about what could trigger a problem, but let's just understand the linkages first. Go on.
Sure. So, thinking about linkages and thinking about how the role that private credit plays more broadly in the financial system. Whenever you see a part of the financial system grow very rapidly, which is exactly what we've seen in private credit over the last 5-10 years, it's always something that grabs attention because it's something a bit new and a bit different. To start with, the linkages between private credit and the rest of the financial system were relatively small. I mean, the classic closed-end fund structures, which is a very similar model to what we see in private equity, that's a place where actually investors are on the hook, and they give money, they commit money to asset managers, to private credit funds, then deploy that capital, they lend that money out to businesses, but it's all pretty contained, because in a traditional kind of closed-end fund approach, investors are committing their capital for 7 years, maybe 10 years. They know that they won't get all of that money back until the end of the fund life, and the broader contagion to the rest of the market may be a little bit limited. It may be particularly something like the psychological channel, which is where, if investors see something going wrong in one place, they might start to worry about things going wrong elsewhere, or they might adjust their broader portfolio. So it's kind of a transmission of risk that way. But over time, that kind of very detached model that I described has really gone away. And now there are many more linkages between private credit and the rest of the financial system.
Got that. So who is most exposed to this space now, in your opinion, in your analysis?
But so far, private credit has been largely aimed at institutional investors, and one of the sectors that we're watching very, very closely is insurance, because in principle, there's a nice matchup here, right? Insurers like long dated assets because a lot of their liabilities, a lot of their obligations are quite long dated as well. So for an insurer, being able to invest in something for the longer term, that kind of 7, maybe 10-year kind of fund life, or maybe even longer, and have assets that deliver returns over that period, it is an appealing prospect relative to other assets that maybe don't have the same degree of maturity. So there's more mismatch between the assets and liabilities of insurers. But insurers' exposure to private credit has been rising quite rapidly, and we've seen increasing partnerships, increasing co-investment, even in some instances, asset managers taking over an insurer and working with them to kind of place assets on their balance sheet. So to create private credit loans, maybe then to structure or package those in a certain way, and then sell that structured or packaged asset to an insurer. And then a large part of the risk sits on that insurer's balance sheet. That's where I think we're particularly focused at the moment. That's also where I think regulators are increasingly focused, those insurance linkages and exposures. But it's also true that the banking sector has got more involved with private credit as well. So I think in the US now, I think US bank loans to what we would say are non-bank financial institutions, which is a broader categorization. It's not just private credit. But I think that's now about 10% of all US bank loans. So that exposure has been rising as well. And if we get into retail, if private credit becomes a retail product, that then just broadens the linkages too.
Is it a retail product yet, Colin?
I don't think so. There's a lot of talk about trying to make private credit a retail product, particularly in the US. And the big challenge there for me is really, I'm not sure that retail investors really understand the illiquidity premium. Right? So part of the argument that both private equity and private credit make in terms of the long life of funds and being able to deliver superior returns is that they can make a bit of extra return because they're able to play in this illiquid space, because investors lock up their money in closed-end funds. Now, with a retail structure, you're likely to have some kind of liquid aspect to it so that retail investors are not locked up for 7 years. Retail investors like getting in and out of products pretty quickly. But that means you need to structure the vehicle so that it would have some private credit exposure. It would have some liquid assets to be able to handle redemptions. That would have an impact on returns. And you may still probably need something like gating, which is a process whereby you limit withdrawals for investors within any given time period, just to manage that kind of liquidity mismatch. Because if you don't do that and retail investors try to pull their money out, then that's where things could get a little bit nasty if you have to sell assets quickly in order to free up cash. And that leads to fire sales and all those kind of risks that we know about. So there's a lot of push, particularly in the US, to try and explore retail private credit. I think the structures will have to be very different. And I think there will be pretty significant implications in terms of returns and risk from those structures compared to, say, a more traditional private credit model.
Got that. Collins, what we'll do is take a quick commercial break here, and we'll come back. We'll talk about the First Brands case, and we'll talk about whether that kind of off-balance sheet exposure is widespread. And we'll also, of course, talk about what can sort of cause an unwind or a bit of a earthquake in this market. If that is likely, what's the probability of that? We'll ask all of that, put all of that to Colin. So take that break. We are back in just a bit. Welcome back. We are speaking with Colin Ellis. He's Managing Director, Center for Credit Research at Moody's Ratings. And we're trying to get our head around the private credit market. And Colin, great speaking with you, and thanks for staying on. Just a quick word before we go any further. Is this, when we talk about the private credit market in terms of size, et cetera, this is largely talking the US in terms of the bulk of it, the size-wise?
Yes, absolutely. This is really where the market started to take off properly after the global financial crisis. There are increasingly private credit funds and asset managers looking at other markets, but it's a little bit harder. It's a little bit more difficult to get into some of those spaces, partly because banks are often still very dominant in terms of lending, as is the case in Europe and parts of Asia. Partly because actually some of the structural features of the market are a little bit different. So one great thing if you're in the credit world in the US is you have some pretty clear defined rules around bankruptcy and what happens when firms really get into trouble. We've all heard of Chapter 11. Going through an insolvency process in Europe is often quite difficult and very different. And that matters because, the ultimate backstop, when you think about corporate failure, when you think about exposure of both equity and credit investors to a company, to an institution, that liquidation process is the ultimate backstop. So, that's the foundation for the kind of worst case scenario, and everything is built off that. So at the moment, yes, still very US dominated, but there is a lot of interest, particularly from the private credit players, in seeing if they can grow these markets elsewhere too.
All right, got that. Now let's talk about what will cause or what perhaps can cause an unwind or a bit of a problem in this area, the private credit market. Would it be interest rates going up? Does it look like it? President Trump is pushing for rates to go down. If into 26 and et cetera. Is that what will cause a shakeout in this space?
Well, I think the first thing to say is a shakeout in this space might take a very long time to be seen. Because the first place we might see it is something like a listed private equity vehicle. Or in the US, we have these business development corporations, or BDCs. And those are essentially perpetual equity vehicles, a bit like ordinary corporates, where investors commit funds, they buy the shares, and then you can see the price of those BDCs. You can see how they're doing and how the market thinks about them, as the share price moves, just as it would for any other company. But in a closed-end private credit structure, it can take a long time for problems to become fully visible. There's still a lot of opacity about valuations. There's still a bit of a question mark, particularly in my mind, about defaults and distress. One of the things I do at Moody's is I lead our work on defaults and kind of rating accuracy and all that kind of stuff. And to be frank, some of the things that we call defaults at Moody's probably wouldn't be called a default by a private credit fund. So if you're an investor in that fund, you may not get the same picture if you're trying to look at their data and comparing it with what's going on in public markets. And that means that you might not spot a challenge immediately. And ultimately, it might only be when the fund is closed or towards the point of closing, when the valuations are all moving towards realized instead of interim valuations, that you get to the end of what's going on. And even if you spot a problem early, if you're in a closed-end fund, getting out of it is a nightmare. I mean, the great example here, because some of these structures for closed-end funds are similar to private equity. There was a PE fund a while ago called Terra Firma, led by a famous financier called Guy Hands. It lost a lot of money through its exposure, I think, to EMI, the music company that it bought and tried to turn around. Everybody knew that was going to damage fund returns. Everybody knew that investors would lose money on that private equity fund. But unless they could find someone else to sell their stake to at a massive discount, nobody got their money back. Even the bit that was 50 cents on the dollar or whatever the final return was, nobody got that back until the fund closed. So within these closed structures, the direct damage can be a bit limited. And I think the challenge is, what about these linkages? And what about these things that have been building that could transmit private credit risks to the broader financial sector?
But you're saying that any of it is a few years out, right? At least a few years out, if so.
Well, so when I look at the private credit distress data now, where you look at the Lincoln index or the index that Proskauer produced, the default rate, the distress rate, it seems quite low and stable. But I think that's because they're not measuring all of the defaults that we would say are defaults at Moody's. Yeah. Over time, because this is a growing market and more players are coming in, we expect returns in private credit to narrow. We think there'll be some kind of spread compression because you've got more suppliers competing for the same risky borrowers. It may take time, if you invest in one of these closed-end funds, to get a complete picture of how that is doing, because there is still opacity about how those valuations happen. And it will definitely take time for you to get your money back, whether that's with a positive or negative return in the long run. That's those closed. Yeah, that's those closed-end structures.
So just one thing, Colin. What percentage of the AUM, right? If you have that number, is through these funds, and how much of that is closed in terms of closed structures?
I have to be totally honest with you, Prashant. I don't have that number off the top of my head. Okay.
Would that? If that number were, say, 60%, 70%, would that matter if it were closed? It basically will delay the finding out part in that sense, right?
Yes. The big difference between the listed vehicles, the BDCs, the perpetual equity, is that you can see the market's view on those very quickly.
Yeah.
And in some instances, some of those haven't done very well, and the share price has kind of fallen, and you get the market sentiment on that. When you're talking about a closed-end fund where the valuation method is maybe a little bit opaque, and maybe things that we might call a default or a distressed exchange at Moody's are not transparently recognized and evident, particularly in the valuations for a private credit fund, yes, that will take longer for that to become visible.
I have many more questions, and so it's a large market. Maybe we'll have to do one more of these, Colin. But for now, I'll say thank you very much for joining us and really taking us through some of the basic stuff as far as the private credit market is concerned. And of course, trying to understand the size, scope, scale of it, the interlinkages, and of course, where risk might lie. Thank you very much, Colin, for being here.
Thank you very much for having me, Prashant.
Well, I hope it was useful. It was useful and insightful for me. And it's a space which we will continue to track with people like Colin helping us along the way. Thank you very much for staying with us here on another episode of the Global Reset. Thanks for watching. More comes up in just a bit.
Thank you for watching us on CNBC TV18. For all news and updates, subscribe to our YouTube channel and watch us on all social media platforms.